My name is Latif Akombi. I'm a fellow of the Institute, and I've been teaching this course for about 22 years now with the Institute. So the new textbook, I'm also a fellow of the Institute of Chartered Accountants. The new textbook is a review of what we have before. With some addition and reflection of some of the current changes in the financial world. So the way I understand the task is to do a general run through of the textbook. So as you know, this is corporate financial. This financial management and strategy. So some new topics have been added, like Islamic banking and the rest. And then there are also emphasis on ratio analysis. I understand we have 4 hours to do this, 2 hours this Saturday, and 2 hours in the next 2 Saturdays. So we won't be able to have this next week. So we have 2 hours now and 2 hours on the 27th, God willing. 20th won't be feasible because myself and my colleague, Mr. Adebanjo, we have a retreat. And that was earlier scheduled far before this one came up. So that's why 20th won't be feasible, but 27th, God willing, will be available. So if you look at the content page, we're talking about scope of financial management, forms of business organization, objectives, regulatory framework for companies, company stakeholders, management, shareholders relationship, audits. So where we have only theory, I want to run very fast through that because I believe you can read those of yourself. Because it's doubtful if the 4 hours will be enough to do justice, unless I'll just be mentioning the formula without doing any serious calculation. Just analyze, throwing light on what you should do in the formula area. So when you talk about scope of financial management, you'll be looking at things like investment, the 3 key decisions: investment decision, financing decision, and dividend decision. They are interwoven. Investment decision means what is a company about? What do they want to do? What project do they want to undertake? What service do they want to render? So once they agree on what investment decision will be, then financing decision comes up. That is, how will the company pay for the investment, whether by equity, by loan stock, or by debt. Loan stock and debt are the same thing, or by share capital. So that's financial decision. Then is in financial, in FMS, we assume that we are dealing with profit-making organization. So how would the company treat its profit? Are they going to distribute it as dividend, or they're going to apply it back into the organization? So that is called the dividend decision. Then also in that chapter 1, you have forms of business organization, sole proprietorship, partnership, limited liability company, public limited liability company. Then the objectives of a company, primary objective and secondary objective. Primary objective, shareholders maximization. What are the things that the company can do to maximize the worth of the shareholders? Shareholders worth maximization. Worth maximization is the primary objective. What can they do to maximize the worth of the shareholder? They have to invest in projects with positive net present value, and they also focus on value, what we call value drivers. Value drivers are those things or those activities that increases the chance of a company succeeding. That's value drivers. So that is an example of value driver is your growth in sales, profit margin, investment in working capital, investment in non-current asset, tax rate, and so on and so forth. Secondary objective can be secondary financial objective or secondary non-financial objective. Secondary financial objective, maximization of asset values, maximization of profit, minimization of cost. Why the non-financial objective? Product, examples are product innovation, excellence, customer service, training and development of staff, commitment to providing good working environment, and being a socially responsible organization. So those are the secondary non-financial. Remember, we have, when we talk about objective, we have primary objective. Again, then we have secondary objective. It is the secondary objective that is classified to financial and non-financial. Financial, if you can measure the objective from the financial statement of the company. Non-financial, if you cannot. Are we together, please?
Yes, sir.
Okay, then
Yes,
we'll go on to the issue. We'll go on to the issue of company stakeholder. Who is a stakeholder? So all those ones, I'm assuming that you're on top of all those. Then stakeholders theory, strong form, minimalist form, and pragmatic view. Then agency relationship, the relationship between the shareholders and the managers. Key concept you need to know there, what is agency problem? When there is conflict between the goals of the shareholders and those of the manager, there will be agency problem. And when there is agency problem, there will be agency cost. That is cost of monitoring the management. Then goal congruence. A concept of that agency relationship means that the ships are sailing in the same direction. That's the goals of the shareholders are the same as the goals of the management. So no, there is no problem there. And then profit satisficing behavior. The thing is that in these early chapters, you can have a lot, is a mind for formal question. A lot of formal question can come out in this early chapter. So profit satisficing behavior, when the management It's just doing enough to satisfy the shareholders, but not an optimal performance. Why will it not continue in the medium to long term? Because of the competition for management job and cost of capital. What are the ways that the company can minimize agency problem? You have profit-related incentives, and then you have share options scheme. Popular question with the examiner: what is a share option? Who are the parties? What are the benefits? That's about 8 or 10 marks. So share option is a right given to the management to buy a number of shares of the company at a pre-agreed price and a future date. It's an incentive, for them to act like owners. So the option is also usually properly priced. Then we have audits, an independent examination of the financial statement. So one of the things you need to know, past question, is you should be able to mention 8 contents of the financial statement, income statement, statement of financial position, chairman statement, corporate governance, all those things. So if you take an average annual report, you will see most of these things inside. So you are supposed to know all this. So I think that's all about chapter 1, basically. Then in chapter 2, we have financial planning and organization. What is the job of a financial manager in an organization? So part of it is to raise funds for projects, security of company assets, relating with investor, managing liquidity. Then you have to understand, you have to be able to say the job titles and functions. The finance controller, what is his job? Financial accountant, what is his job? Management accountant, treasurer. And then we have the types of planning: long-term planning, medium-term planning, short-term planning. Then budget. The difference between a plan and a budget is that a budget is a plan to which value has been attached. Let's say you plan to buy a car this year, and you now say, okay, the value of the car, if you plan to buy a car ordinarily, you leave it at that without any monetary value attached. That is a plan, that you plan to buy a car, a new car. But if you now attach value and say you plan to buy a new car for 10 million or 15 million or whatever million, it becomes a budget. That's why we say budget is a quantitative statement of plan, prepared and approved prior to the period to which it relates. And we have various types of budgets. Sales budget, production budget, general admin budget, capital budget. Capital budget is budgeting for non-current assets, fixed assets. That's what is called capital budget. In most organizations, they talk about CapEx. In other words, capital expenditure decision. Okay, so master budget and cash budget, which are more or less summary budgets, because the top management or the board of directors won't be able to look at all budgets. So the summary budget they will look at is the master budget and the cash budget. Cash budget is the budget for cash inflows and outflows. In real life or in practice, it is called cash flow projection. When you want to take money from the bank or from a lender, they can ask you, let's see your cash flow projection, so that we see whether you are able to pay back or not. So that's the essence of cash flow projection. Then we've got budgetary system. Budgetary system, that's We're talking about fixed budget, variable budget, which is the same as flexible budget, periodic budget, rolling budget. The method of budget preparation, if you have been following the government news, we have incremental budgeting, which was what they claimed to be doing in the past. And now they have claimed to change to zero budgeting now. All these types of budget, you have to be familiar. Then, of course, the benefits of budgeting. What does it do? Provision of clear guidelines. It's a way of doing management by exception, coordination of activities, delegation of responsibility. So that is about budget, and that's actually about chapter 2. Chapter 3 talk about the financial market. Financial market, that is a market for trading financial assets. Financial assets are mainly paper assets. The financial market can be classified into capital market and money market. Capital market, where long-term funds are traded, and money market, where short-term funds or short-term securities are traded. The capital market you subdivide into primary and secondary. The examiner can ask you to differentiate. Primary market is where new securities are issued. Secondary market is where existing securities are traded. The stock exchange and the SEC, they play a role in the primary market, and then of course the Nigeria Exchange Limited, stock exchange, also play a role in both capital and money market. So you can Google their site to see more of the story about that. Then of course, there is requirement for listing the type of board. We can be listed on the premium board, on the main board. And then of course, the growth board. So all the requirements you need to know. The advantages, what's the advantages of being listed? It's become easier to borrow money. Long-term funds can be raised. It enhances liquidity. Profile is enhanced because you're a listed company. But it also have its disadvantages, as it can be very expensive cost of entry. It can also be very expensive cost of compliance. Then public scrutiny, you are like a goldfish, no hiding place when you're a listed company. And then a company can be exposed to hostile takeover. Recently, you see what happened between Otedola and what is this, Tony Elumelu. When Otedola is trying to buy some of their shares, and they have to buy him out eventually. So you need to read that on this. Now, if it's not a public company, Otedola, it will be difficult for Otedola to make that move. But because it's a public company, the shares are available, so you are open to hostile takeover, which is what the whole picture is looking like, even though it has been rebuffed by the Elumelu group, but it was very expensive for them to rebuff him because they have to buy back the shares he has. And of course, he's going to set the price he wants to sell. Are we together, please?
Yes, sir.
Okay, you see, I'm being fast in those areas because you don't have, these are all stories that you can read up. Then another thing in that chapter, you have to know the different sources of finance. You have to know the difference between what is hedge funds and mutual fund. And the unit trust and hedge fund. The only difference is that hedge funds takes higher risk and they give higher return. The risk is high in hedge fund and they also give higher return. Both accept deposit from investors. So Then, of course, you have money market. Then you have the option market. Remember I mentioned share option earlier. The share option is just a scheme, share option scheme, a scheme to encourage the management, where the management are given the right to buy shares of a company at a future date, so as to make them behave like owners. Because if they know that there will be future ownership of the shares, perhaps they will behave and reduce the expenses and the lavish lifestyle or luxury lifestyle they live at the expense of the shareholders. But yeah, the option market, you know, when we talk about the money market, we subdivide it into three: the forex market, the option market, and the interbank market. Forex market, we talk about that when we come to foreign exchange management. Interbank market, the market where banks lend to each other, and the option market. Option is a right, but not an obligation to buy or sell shares at a future date and an agreed price. So the right to buy or sell. So the right to buy is called a call option. The right to sell is called a put option. There are two parties in an option. You have the writer and you have the option holder. Exercising the option is at the discretion of the option holder. The option holder can decide to exercise, or he may decide not to exercise his rights. Options are flexible. You only exercise your right when it is profitable to do so. So, and when it is profitable to exercise your right, we say the option is in the money or above water. When it is unprofitable to exercise your right, we say the option is underwater. So that is about option. There's always a striking price. For example, let's say somebody has an option to buy bags of cocoa at, let's say 100,000 naira. And then at the strike date, bag of cocoa is now going for 130,000 naira. So that is an option that is in the money, because he has a call option to buy for 100,000 naira. So you can buy the bag of cocoa and turn around in the market to sell it at 130. So that option is in the money or above water. So we advise that he should exercise his rights under the option. But if assuming he has entered the option to buy at 100,000, then in the market, the price has dropped, the bag of cocoa is now selling for 80,000. Then that call option is out of money, because it doesn't make sense for the option holder to exercise his right. He cannot be buying something that is worth 80,000 naira for 100,000 naira. So if he loves the transaction trade so much, then it's better for him to go to the market to buy. So in that case, we say the option is out of money. Then we can have straddle, what we call straddle. That is an option that has both right to buy and sell. That's called a straddle. You know, the way you straddle a horse, you are neither here nor there. Then you have what we call American option and European option. An American option is an option that can be exercised on or before the strike date. That's American option. European option is an option that can only be exercised at the strike date. So the examiner can ask you to differentiate between the American and the European option. American option is also known as traded option. American option is also known as traded option. So there are so many money market instruments that are mentioned there certificate of deposit, repo agreement, commercial papers, and so on and so forth. Okay. Then we have bond market, trade credit. Then still in that chapter, you have leasing, a transaction between a lessor and a lessee, where the lessee, the user of the asset, is using the lessor's asset in exchange for payment of lease rentals, regular payment of lease rentals. That is a lease. The two major types of lease that we have: finance lease, operating lease, for the purpose of accounting, for the purpose of finance. And of course, there are differences. The risk and reward rest with the user, the lessor in finance lease. It rests with the lessee in operating lease. Then you look at so much of those differences, because it's also popular with the examiner to ask you to differentiate between finance lease and operating lease. Then we have what purchase and lease back, where you sell an asset, usually a building, lease it back immediately from the new owner. Lease and hire purchase, very similar, but in finance lease, at the end of the lease period, purchasing the asset is an option for the lessee. But in hire purchase, the lessee it is his load. He must buy the asset at the end of the lease period. So they can ask you to differentiate between those two. And then another thing you need to do, you need to read up or Google government establishment like Bank of Industry, Bank of Agriculture, Federal Mortgage Bank, Nigeria Import-Export Bank, and so on and so forth. You know, all these Nexim, African Development Bank, World Bank, these are more or less current affairs. Some of your questions will be current affairs, about 5 or 10 marks will be current affairs. What are the functions of the World Bank? They have asked in the past. So all these things you have to know. People that attend my regular class, I used to tell them, look, they need to read financial newspaper like Financial Times, Economist, Business Day, and so on, so that you get familiar with what is happening in the financial world. Then we also have financial derivative. A derivative is a financial instrument that with a value whose value depends on the value of another underlying asset. It's not an asset on its own. It's like a package asset. It depends on something else. The underlying asset could be commodities, could be bonds, could be loans, and what have you. Okay. Now we are gradually from chapter 4, then you are having serious calculation, share capital. From chapter 4, you get into computation. So what we are looking at there is share capital. So we look at number 1, first of all, differentiate between preference share capital and ordinary share capital. So I'm assuming that being lawyers, some of you all know the difference between preference share capital and ordinary share capital and what they have rights to. Then another key thing is method of issuing shares. Offers of subscription sales by tender, offer for sale, private placement, vendor placing, right issue. Right issue is where you have the first 20 marks that can happen. So you need to be able to calculate the S right price, the value of rights, and what will happen when a shareholder, whether a shareholder take up his right, says his right, or take no action. I don't want to get into specific questions here because if I start to solve, some of you that have attended regular classes, you know, one question can be solved for 2 hours so that we don't end up spending all the time that we have that has been allocated to us on solving one question. So that's why I won't go into detail solving of question other than just trying to give a kind of guideline on how to answer question. In a right issue, of course, right, we all know right issue is the shares that are offered to existing shareholders in proportion to their current shareholding at a price below the current market price. There could be a question there. Why is right issue offered at a price below the current market price? And the reason is to encourage the current shareholders to take up their right so that the company can raise the desired fund. That is the reason why its right issue is done at a lower price than the market price. And then why is right issue? What is the attraction in doing right issue? There is no dilution of shareholding. It's still the same number of shareholders. So there is no dilution of profits. It's cheaper to public offer relatively, because if you have to issue prospect, you don't have to issue 10 more story, you know, because you can't be preaching to the converted. The people you want to sell to are already your shareholders, so you don't need more convincing to do that. So it's cheaper. It's also cheaper for the shareholder to increase the shareholding without paying transaction costs. Those are the advantages of right issue. Then you have to be able to calculate theoretical S right price. It could be 4 marks, it could be under 20 marks. Theoretical S right price. That's the weighted average price of old shares and new shares. Let's say a company is doing 1 for 2, 1 new share for every 2 already had. The total number of shares there is 3 shares. Let's say the new share will be sold at 5 naira, and the old shares are trading at 10 naira. So that means that if you have 2, that is 2 times 10, that is 20, plus the 5 naira of new share, 25. Then you divide by the total number of shares after the right, which will be 3, 2 plus 1. So you've got 25 over 3. The answer is your computation for your S right price. Then you have to need to calculate the value of a right or the value of rice. The value of rice, that's the gain that's the difference between the theoretical S right price and issue price. So then the only time you lose money in a right issue is when you don't take any action. That can be proven by computation, and you have that computation in the textbook. The only time you will lose money is when you take no action. But if you invest If you take action, whether you take up your right or sell your right, or take some and sell some, you will still gain some money in right issue. So that is about right issue. Then we have advisors to share issue. Who are the advisors and their functions? The examiner can ask you, what are the functions of the issuing house? What are the functions of the underwriters? What are the functions of the stockbrokers, accountants, and then the solicitors? What are their functions? Then it is still in that topic, we have a kind of pricing of new shares, where we mention two methods of pricing. The earning method, PE method, price earning ratio method, and the Gordon's dividend growth method. Those are the two we mentioned there. Then it's also there that you have the venture. You have the venture there, you know, redeemable debenture, redeemable. Redeemable, the money will be returned. Redeemable, it will not be returned. Convertible, it can be converted to ordinary shares. And then when you talk about convertible, there are some calculations there you should master. Advantages and disadvantages.
That's a point as it helps.
Kinde, are you asking a question?
Okay.
So you have to be able to distinguish between corporate bonds and government bonds. Which one is more risky? Of course, corporate bonds are more risky. Government bonds are less risky because they have the opportunity to print money, ways and means financing.
Sorry, sir, please answer a question.
Okay.
Please, what's the meaning of number of rights? How do you do rights?
You mean right issue?
Yes, sir.
Okay, for example, I just mentioned about a company doing one new share for 2. 1 for 2. Current share price is 10 naira. Issue price is 5 naira. So in that kind of example, the number of rights is 2, because the number of shares you have also constitute your rights. If you have 2 shares, that means you are entitled to 1. So those 2 are still your rights. You can sell your rights without necessarily selling your shares. So the number of shares you have is also the number of rights you have. Do you follow?
Yes, sir.
Okay. Note advantages and disadvantages of convertible bond to the issuer to the bondholder. Then the calculation there, conversion ratio, number of shares at conversion date over nominal value of loan stock. That is conversion ratios. Then conversion price, nominal value over number of shares at conversion date is the inverse. Conversion ratio and conversion price are inverse of each other in terms of formula. And then So conversion premium is the gain that the issuer is going to make from the issue, market value of loan stock over number of shares at conversion minus current share price. That is conversion premium. Then we have warrants, which is attached to a loan stock, giving the loan stockholder the right to buy shares at a fixed price and a future date. That is warrants. So that also has its own calculation. We also have premium in warrants. What are they? What is the issuer gaining? And we have theoretical value of a warrant. And of course, they can ask you when would the theoretical value of a warrant be 0? When the share price at strike time is lower than the strike price. After that, it's still in that chapter, we have Islamic banking. You can Google all this. The major feature of Islamic banking is that all interests are prohibited. It is called riba. All interests are prohibited. So interest-bearing bond is not allowed in Islamic banking. So you have to read up on the basic instrument. It's also in the textbook. The basic instrument they use, cost plus financing, muraba, profit sharing, mudaraba, and so on and so forth. So, hello?
We can hear you,
Hello,
sir.
sir. Hi, sir.
Okay, dividend policy. The main thing you need to know in dividend policy is the factors that affect dividend policy. Those factors that affect dividend policy, those are the main issue that you need to know.
Remember writing exam next month. Me, I'm not writing. I just joined them and hear the lecture.
If you are not writing, don't disturb us.
Yes.
It's not by force. That's why it's a professional exam. Everybody has come to the paper of his own free will and accord. But then we can't disturb others who are writing. So I move on. Again, I'm not really delving into the deep calculation, trying to solve questions because of time. It's only 4 hours, 2 hours this Saturday, 2 hours in the next 2 Saturdays of 27. Not next week, please. Please note. My colleague and I will be at a retreat next Saturday, so we won't be available for this session. God willing. But God willing, on 27, we'll conclude whatever we are. So the next topic, chapter 5, is cost of capital. What is cost of capital? It is the return that is expected by the providers of finance. Cost of capital is the return that is expected by the providers of finance. Why should a company? It is very well, when we talk about capital, remember the major capital are ordinary share, preference share, and bond. And when we talk about capital, cost of capital, why should a company know its cost of capital? It's very, very important. Number one, it allows them to know the project to accept. Some of you that have gone through investment appraisal, you know what we mean when we are discounting. A basic example is when you borrow money from the bank. Let's say you borrow 20 million from the bank at say 25%. So that means basically your interest per annum is 5 million naira. I hope I'm right, 25% of 20 million. Your interest is 5 million naira. So when you are, if it's a 1-year loan, you need to pay back 25. Anything you want to invest the money in should give you more than 20% return. That is when that borrowing will be sensible. So cost of capital helps you to determine what project to undertake and what project not to undertake. It also helps you to know the expected return by the providers of finance. Because if you don't give adequate return to the provider for finance, they are likely to divest from your business and go elsewhere. So that's why another reason cost of capital is important. It also helps to know the capital structure that you should employ. What is the mixture? What is the percentage of debt? What's the percentage of equity that you should use? So that helps. That's why it is important to know cost of capital. And since we are talking about long-term capital here, we have cost of equity, cost of debt. So we have cost of equity, cost of debt, cost of preference shares, and WACC. Cost of equity, we are talking about ordinary shareholders. What is the cost? There are two methods there. Basic method, you have the dividend yield method, which says K equals to D over PO times 100. And you have the capital asset pricing model method, which says RS is equal to RM plus RF into RF plus beta into RM minus RF, sorry. RF plus beta into RM minus RF, where RF is the risk-free rate of return. It's also known as the return on government security or return on treasury bill. Instead of calling it risk-free, the examiner can call it return on treasury bill. So you know they are talking about RF. Why RM is the return on the market portfolio. So they can call it return on the stock exchange. So you know they are talking about RM. And beta factor. So
sorry, sir, please, could you repeat the other word for RF and RM? The other word for RF and RM.
RF is return on treasury bill. That's also RF. Or they can say return on government security. RM is the return on the stock exchange or a major exchange.
Thank you, sir.
You're welcome. Yeah. Okay. So that is cost of equity. Then there are three formula you need to know in cost of equity. You need to know the dividend yield formula, which is K equals to D over PO times 100. The Gordon dividend growth formula, which say K equals to D into 1 plus G over PO plus G. And the capping, which say RS equals to RF plus beta into RM minus RF. Those are the three basic formulas that are applicable in cost of equity, depending on the data that you are given. Excuse me, please. Hello.
Hi, sir.
Okay, so
Hi.
those are the three basic formulae you need for cost. Those are the three basic formulae you need for cost of equity.
Sorry, sorry, sir. Sorry, sir. I didn't get the formula clearly. Is it dividends-based method, growth formula, and the CAPM?
Yeah, the dividend growth, dividend yield method, dividend yield.
Okay.
Dividend yield method.
Yes, sir. Yes, sir.
That is KE equals to DO over PO times 100.
All right, sir.
Then you have Gordon's dividend growth method. Gordon's dividend growth method. K equals to D into 1 plus G over PO plus G. Then you have, what do you call it now? Capital asset
CAPM.
pricing model, CAPM, which is RS over, which is RS equals to RF plus beta into RN minus RF. And we say the RF is risk-free rate of return. It can also be known as return on government security or treasury bill.
Yes,
Why
sir.
the other one can be called market return. Then you have to be careful. I remember something now. If the examiner have done the RM minus RF, the bracket, he will call it market risk premium. The RM minus RF as market risk premium. So if they have done the deduction, they won't call it the market return. So you have to be careful there.
Yes, sir. Thank you, sir.
Then there could be variation when there is new issue of shares. When the examiner is talking about new issue, you have to adjust for the issue price. When the examiner is talking about new issue, you have to adjust for the issue price. So if they are talking about new issue of shares, then your PO must be less the issue price. So if it is dividend yield, it will be K equals to D over PO minus I times 100. If it is the Gordon growth that you are using, it will be K equals to D into 1 plus G over PO minus I, the issue price. Because when you are dealing with new issue, the company or the issuer, we have to pay the advisors from the money they raise. That is why the PO will no longer be the same when you are dealing with new issue. Then another technicality there is make sure your share price is ex dividend. And that is the share price after dividend have been paid. If they tell you that dividend is yet to be paid, it means that the share price you are given is cum dividend. So for you to get the ex dividend, you need to deduct the dividend. Let's say they say share price is 6 naira, dividend is yet to be paid, and a dividend of 80 kobo has been declared. You cannot say PO is then 6 naira in that question. You will be wrong. What you will say is PO equals to 6 naira minus 80 kobo. So you'll be 5 naira 20 kobo as your PO. You know, those are the little technicality that can be inserted in the question to test your deep knowledge of the topic. So that is about cost of equity. Then we have cost of retained earning. Retained earning is money that belongs to the shareholders. So the cost of retained earning is the same as the cost of ordinary equity. Then we have cost of preference share capital. Remember, preference share capital is an hybrid form of capital. Preference share capital is an hybrid form of capital. So when you are talking about cost of retained and cost of preference share, is either it is redeemable preference share or irredeemable preference share or convertible preference share. So for redeemable preference shares and convertible preference shares, we use IRR. For irredeemable preference shares, that is the one we use the formula KE equals to DP over PO times 100. KE equals to DP over PO times 100, where your DP is preference dividend and is always a percentage of nominal value. Your DP is preference dividend. Your PO is share price ex dividend. Your PO is share price ex dividend. Are we together, please?
Yes, sir.
And of course, you know,
Yes, sir.
Okay. Question? John, do you have a question to ask?
No, sir. No, sir.
Okay. All right. So that is for preference dividend. And when you talk about debt, cost of debt, KD, if it is irredeemable, KD is equals to I over PO times 100 when there is no tax. Remember, part of the return on debt or loan stock or bond or debenture, they are used interchangeably, is interest. Unlike the equity and the preference share capital that we were using dividend, here we use interest. Interest over share over unit price of bond times 100. That is when there is no tax. And for irredeemable bond, when there is tax for irredeemable bond, KD cost of debt will be equal to I into 1 minus T over PO times 100. So you adjust because interest is tax deductible. And that is why another question they can ask is, why is it that company prefer to issue bond than issue preference share capital? It is mainly because of the tax advantage. Interest on bond is tax deductible. That is, a company can use it to reduce its tax liability. The dividend on preference share capital is not tax deductible. So a company would prefer to issue the one that can give him tax advantage than the one that will not give him tax advantage. That question is also asked by saying, why is issuing of preference share becoming unpopular? That's another way of asking the question. Why is it unpopular? Okay. Then there are also assumptions, though. You pay attention to the assumptions because they can be like five marks.
Sorry, sir, why did you say the reason for issuing of preference shares is becoming unpopular? Because of the interest on the tax.
Because the dividend on preference share is not tax deductible. So a company will prefer to issue bond than issue preference share so that they can have tax advantage. Do you follow?
Yes, sir.
Okay. 1 minute, please. There is rain there. 1 minute.
Sorry, please. Did you say the interest on share capital is deductible, unlike the interest on bond, which is not deductible?
So the interest on preference shares is not deductible, unlike that of bond. So that's why they rather issue the bond than preference shares.
Tax deductible.
Can you mute your phone, please?
Sorry, can someone explain what tax deductible means? And when you say something is tax deductible, what does it mean? Like, please help me.
Maybe I can explain it in a layman's term. Okay, so when you say something is tax deductible, say for example, interest. When they pay interest when a company pays interest, to the people they're giving their bonds to, right? Before they, that interest is calculated into their profit, right? So when, the tax people would want to come and, collect their tax, they will factor it in and say, okay, because you pay so interest, we will reduce the tax for you, the tax you're supposed to pay. They won't factor that interest. They will factor the fact that you've paid interest. Do you get? So that's what it means by tax deductible. But dividend is not tax deductible, which means when the tax people come to collect their tax, they don't care if you've paid dividend or not. They would compute that tax based on your profit, because dividend is also, gotten from profit. I don't know if you get my point. So they will collect their tax based on the total, what you have. they don't mind if you pay dividend or not. So it's dividend and your profit, everything, they will compute that tax and then you will pay. But for interest, they factor the fact that, okay, you've released some money to your bondholders, which is your interest. So for that, when we're computing your tax, we factor that in and give you a lesser tax to pay.
Oh,
I don't know if that's
very
Yeah.
much.
Let me also help. After making a company made a profit, you have to deduct the bond, the interest in bond, and pay to those bond holders. In that one, they're not going to charge you tax. The one they will charge you tax is the remaining profits from where you will use and pay for shareholders, which is preference share and others. So that one is where they will charge you tax. So that is why they say they will have to minus that money used to pay for interest in bond. So that one is tax deductible. But in that preference share, they will charge you for the whole profit, the whole money remaining. So that's why they said in preference share, it is not tax deductible. You don't minus tax before paying. They will assess you the whole of the money in the profit. They will assess you the tax and you pay. But in that bond, they have to minus the money for interest and for bondholders before you pay tax. I don't know whether I explain it.
Yeah, thank you very much. Thank you. Thank you. Good.
No.
Okay, so that's
Hello.
about, yes, Uzioma.
Please continue, sir.
Okay. So that is about cost of equity, cost of preference share, and cost of bond. Now, for redeemable bond, the cost of redeemable bond is obtained by calculating IRR, internal rate of return, which is what is best done with MPV. And then we have WACC. Most companies don't use just their equity or shareholders' money. So they use many sources of finance. So you need to calculate what is the weighted average cost of the capital. And when you are evaluating a project, it is the work of a company that should be used to evaluate a project, not necessarily the source of finance for the project. So that's a summary of what I've done is to run through. And you, of course, now there are theory questions in this paper. So you have to study the theory aspect of this paper too. Don't be carried away with only the calculation. So read the theory, like in this work now, there are arguments for work and there are arguments against the work. So it's important. Work can be calculated on book value basis. That is according to the financial statement of a company. And it can also be calculated on market value basis. Are we together?
Yes, sir.
Yes, sir.
Yes, sir.
So how do you get the cost of capital for an unquoted company? When a company is unquoted, that means it's not listed on the stock exchange. What you do is you get a listed company of similar size, and you can adopt the data of that listed company of similar size for the unquoted company. That's the way we determine the cost of capital for an unquoted company. So that is about chapter 5. Then chapter 6 talks about capital
Sir, please.
structure.
So I want to ask a question. Sir,
Okay.
please, before you go to the next chapter, before you took a break, you were trying to tell us about 5 assumptions under the cost of capital structure, but we didn't go through that anymore.
Now, I said there are assumptions there. It's in the textbook. I'm saying you should go and read it.
Okay.
There are assumptions there. They are not calculations. So
Okay, sir.
So capital structure, we're talking about the mixture of equity and debt in the financial
Yes, sir.
structure.
Excuse me, sir.
And
Sir, please,
yeah,
what's the formula for WACC?
I don't use formula, I use table.
Okay, sir.
I don't like the formula approach. I'm not saying there is no formula, but my style is to try to simplify the course as much as
Sorry, sir, we lost you a bit. We lost you a bit.
So I try to simplify it because I know most 90% from my 22-year experience in with the institute, 90% of the candidates are not account or finance people, they are lawyers. So I don't use formula for WACC, I use table. And that's what you will find in the textbook. You won't find a WACC formula in the textbook, except in this structure also.
But sir, you use formula for the cost, yes?
Sorry?
You use formula to calculate the cost.
Yes, you do. The cost of equity, you use formula.
Thank you, sir.
Let me try and see. I'm trying to share the soft copy of the textbook.
Thank you, sir.
Can you see my screen?
Yes, sir.
Yes.
Yes, sir.
Okay, look at this example. Calculate the WACC. So if you have the textbook, this is about page 72. So calculate the WACC using the following information. You are giving book value. You are giving market value. Remember, we mentioned that WACC can be calculated on book value basis or market value basis. The company have already calculated the equity to be 17% and the tax rate to be 30. So when you come, this is what I'm saying. Look at, this is my table for WACC on book value basis. You can see the book value 212, totaling 5. Where do I get 224? If you come to the question, see book value 212, ordinary, preferred, and bond. So, and then when I do that, I work out my proportion, 2/5, 0.4, 1/5, 0.2, 2/5, 0.4. Your proportion should always add up to 1. Cost, 17% is already calculated according to the question. The cost of equity has been calculated to be 17%. I think this was even repeated in some past questions, word for word. Sometimes the examiner will just list, they will lift what you have in the textbook. And that's why it is important. Part of your revision should be working on the work example and the practice question. So now 17%, but the 12%, you need to work it out. Cost of preference share, KD, 12% of 1 equals to 12%. Where is the 12% coming from? If you come to the question, 12% preference share. 12% preference share. So your preference dividend is a percentage of nominal value. And then look at the cost of debt. This is the working for the cost of debt. 10% of 1,000, this, which is the interest. You know where 0.7 is coming from, 1 minus T over 1. So 6.4. So this is basically my own approach to working WACC. Some other people use formula. I don't like to use formula. I believe the formula is too complicated. And this is the one on market value. So I hope that gives you an idea of what I'm talking about.
Yes, I would have wanted you to, the same way you ran through the book value. Maybe you just run through that market value, especially that calculation bit, you know, how you got that.
Okay.
The formula bit of it.
Okay. So if you look at the market value means you need to work out what is the market value. Market value of any security is number of shares times the share price. Number of shares in issue times share price. If you go back to you can still see my screen, right?
Yes, sir.
If you come to the question here, we were told that there are 4 million shares of 50 kobo. It is 4 million times 50 kobo that give book value of 2 naira. 2 million, sorry, 2 million naira. To get the market value here, you will take the 4 million and multiply by 2 naira 50 kobo. And that is why we have 4 times 2 naira 50 kobo is what gives us the, where is it now? That's what gives us the 10 million we have here. 4 naira times 250. Yeah. Market value is more tedious than book value. Then when we go up here, for preference share, so for preference share, it will then be 1 naira per share. What is the implication of this? 1 naira nominal is also trading as 1 naira per share. This is where we say the share is trading at par or is trading at face value. So the book value will be the same with the market value. Hello?
Yes, sir.
So that's why the preference share, you can see the market value is also 1 because it's trading at par. Then for the bond, where is the bond now? So for the bond, you can see 1,100 per 1,000 nominal. So you take the 2 million, divide it by the 1,000 nominal to know the number of units and multiply by 1. So the market value here will be 2 million divided by 1,000 naira times 1,100. And that is what gives us, if you come here now, I think about 2.2 million. So we add up everything, giving out 13.2. We now start our proportion, 10 over 13.2, that gives you 0.76. 1 over 13.2, that gives you 0.076. 2.2 over 13.2, that gives you 0.17. If you add up this, you should have 1. So the cost is still the same cost we have calculated before. It's the same cost you use in book value. That there will be no difference in that one. You can see. Then you multiply your cost by your proportion. And then the WACC here will be 14.92. You look at it here, the WACC here is 11.76. Of course, market value will always be higher. And there are some questions they would have given you proportion. You don't need market value again. If they have given you proportion, then you don't need market value. Because the essence of market value is to enable you to calculate proportion. So you have to be flexible in essence. In the exam, you have to be flexible and be relaxed, no matter your level. I know being calm in the exam also has to do with your level of preparation. But if you have done all you can do, like there's a book in motivational line, which says all you can do is all you can do, but all you can do is enough. That's a very popular book in network marketing. So if you've done all you can do, then you just have to be calm in the exam. That is the only way you'll be flexible. You can adjust to question or any surprises being thrown at you by the examiner. Okay, I hope that clarifies what your questions are. Again, we can't go into detailed calculation here because otherwise we'll spend the 2 hours on just one question. Some of you in regular class, you know, sometimes we spend 2 hours solving just one question. So we don't want to do that. The institute has said it's a revision, so that we should not run through the book. Okay. So when we talk about capital structure, the next chapter now, we are saying what is the mixture of equity and debt in the financial structure of a company. When we say equity, we refer to all the funds that belong to ordinary shareholders. So equity will include ordinary share capital, retained earnings, share premium, revaluation reserve when we say equity. So equity is not referring to only ordinary share capital. That's part of the common error in under this topic. When we say equity, it's not only ordinary share capital. You have to add up all the funds that belongs to the ordinary shareholders. And when we say debt, the technical part of it is preference share capital is treated as debt because it carries a fixed rate of, it is a prior charge capital. In fact, another definition for debt is that it should be prior charge. Prior charge means that a prior charge capital is a capital that we attract return before the ordinary share capital. So when we say debt, we are referring to prior charge capital. That is how you will treat equity. Sorry, you will treat preference share capital as debt because it carries a fixed rate of dividend. And that dividend must be paid if there is profit, of course, with all the other factors affecting dividend policy, must be paid before the ordinary dividend. Otago? Hello?
Yes,
Yes,
sir.
sir.
Yes, sir.
Okay. Now, so that is about, when to measure the level of debt in the financial structure of a company, we call it gearing, capital gearing or leverage. So that's how we measure the level of debt in the capital structure, capital gearing or leverage. So how do we calculate that? The first formula is debt equity ratio. Let me share maybe I should share my screen, this formula area now.
You're sharing your screen.
Sorry? Okay, you can see my screen already, right?
Yes.
Okay, so look at it here now. Debt equity ratio, gearing is equal to debt over equity times 100. That's debt equity ratio. And this one has no cap. Somebody is disturbing also. Then we have debt capital ratio, where gearing is equal to debt over total capital times 100. Total capital is debt plus equity. So those are the basic formulae for calculating gearing. A company can be low geared or high geared. If the proportion of debt in the capital structure is low, let's say a company has 200 million share capital, they are using equity is 150 million and debt is 50 million. That's a low gear company. You can compare to another company with the same 200 million capital structure, but where debt is now 120 million and equity is 80 million. So that is high gearing, and that will reflect in your calculation. If you do that equity 120 over 80, what do you have? 120 over 80, what will you have?
1.5, sir.
120 divided by 80 times
1.5.
100. That means debt is 150% of equity. I'm trying for you to see the difference between the two formula. If debt is 150, 120, equity is 80, this formula will give you 150%. But the second formula, what will it be? That will be 150, 120 over 200 times 80 times 100%. That will give you about 60%. Do you get what I'm trying to say now?
Yes, sir.
In the debt to total capital ratio, it tells you, okay, debt is 60%, equity is 40%. So that is high gearing. But in the first formula, it will tell you debt is 150. So the first formula, that is the disadvantage. It has no cap. There's no limit to what the answer you can get. So a company can be low geared or high geared. Then when we say valuation, we can also value on market value basis or book value basis, just like we did in WAC for gearing. Then there is the issue of risk in capital structure. There are two types of risk: business risk and financial risk. All companies have business risk. Whatever you do, as long as you operate in an economy system, you have business risk, because those are risks that you cannot avoid. It's also known as unavoidable risk, such as and so for general labor strike and things like that. Financial risk is a risk that arises as a result of using debt. The only time you have financial risk is when you borrow. So now that throws up a popular format question with the examiner. The examiner will now ask you, will a geared company, will the cost of equity of a geared company be higher than the cost of equity of a non-geared company? Or let's say the cost of equity of a geared company, it will be higher than the cost of equity of a non-geared company, true or false? There was a diet, they did that, they were just in true or false, yes or no. And you would think people will pass well. It was disaster. So what will your answer be?
So can you repeat the question?
The cost of equity will be higher than the cost of equity of a geared company will be higher than the cost of equity of a non-geared company. True or false? Give reasons for your answer.
True.
Correct? True. What are the reasons?
Higher risk and higher returns.
No, that will not be correct. If you just say that, yeah, that should be a conclusion. Higher risk, higher return should be conclusion. There are some, background build up to that conclusion.
The cost of capital for a highly geared company will be higher, will be very high.
The cost of equity. The cost of equity. I said I use the cost of equity, not the cost of capital.
Yes. Cost of equity, not the cost of maintaining the highly geared, the capital, the highly geared capital will be very high, unlike that of the ungeared company.
You are wrong. Your reason is wrong.
It's because a geared company has both financial risk and business risk.
You are not referring to the background now. You are just jumping to conclusion. It's just John. You are,
okay.
Thank you for me. You have to refer to the business and financial risk that we are saying now.
All right, sir.
Yeah, the examiner won't give you marks for that. He will say, in fact, he will say you just guess. It was a tokening to keji, like Yoruba will say. You just do tokening to keji. But you have to refer to the fact that the geared company have both business risk and financial risk. The unjail company has only business risk. So the higher the risk, that's why I said what you said was a conclusion.
Okay.
But you mention the key point itself. That's the only way they will give you the full marks for that. All right. So those are the two risks in, then we have interest cover. Interest cover is number of times the company can pay interest from its PBIT. PBIT is the same as EBIT. Is the same as operating profit, because you know they can use so many words. Then we now go to another journey, which is called operating journey. And I will want you to note that operating journey has no other name. If they want to call it operating journey, they don't call it anything else. It should be called operating journey. But the other one, the journey we just talk about has so many names. It can be financial journey, it can be capital journey, it can be leverage. But this operating journey, the only name it has is operating journey. Are we together on that?
Yes, sir. Yes, sir.
Okay. So operating journey measure the level of fixed cost in the cost structure of a company. Is the level of fixed cost in the cost structure of a company. What are fixed costs? Fixed costs are costs that do not change with activity level. They remain the same regardless of your activity, your business activity. Example of fixed cost is your rent. If you rent an office and you travel, you go on holiday, at the expiration of the rent, you didn't come back, you were enjoying the place so much. At the expiration, the landlord will ask you for another money. Well, and meanwhile, you have not earned 1 naira from any actual activity in that office, but you will pay again. True or false?
True.
True.
So that is why rent is a fixed cost. So we are now saying when a company is operating, what is their level of fixed cost? The higher the level of fixed cost, the more risky the company, because those are costs that they must cover. It's just like another example I use is you have a law practice. Maybe you are just starting out and you have a associate or partner, and the salary is about 200, and then you have a cleaner who is about 40,000 naira, that is 240. You have a reception who is on about 80,000 naira, that is 320. And then your rent, maybe if you work it out per month, your rent comes like, let's say 100,000. So in essence, you have 420,000 naira to pay in a month, whether you like it or not. And you have not included your own salary, your own fuel and everything as the managing partner or whatever you call it. So that is why in business, you have to manage your fixed costs. The lower you can keep your fixed costs, the better for you. The higher your fixed costs, the more risky you become. And that is what operating journey is trying to tell us. And operating journey, the formula is contribution over PBIT. What is contribution? Sales minus variable cost. What is variable cost? Those are costs that vary with activity level. If you have an office, you are not doing anything there, so you will incur transportation to and fro from the office. That's a variable cost. Transport, Uber or transport fee to the court. If you don't have anything to do in the court, that's a variable cost. No paper, no stationery expenses if you have nothing to print. So those are variable costs. So there are two formulae for variable costs. Sorry, for operating journey. You can see the two. The first one is contribution over PBIT. The second one is fixed operating cost over total operating cost. And look at the example. a company has a turnover of 120 million, variable cost is 80, fixed cost is 30. Calculate the operating journey. So operating journey, if you use this formula, contribution will be 120 minus 80, 40 over 10, 4 times.
It's under.
So operating journey will be 4 times for this. And when you go second formula, 30, the fixed cost is 30 million. Let's go back to the question. Remember, the fixed cost is 30 million. The variable cost is 80 million. So total cost is 80 plus 30, 110. Then that is why your operating journey calculation here will be 30 over 110 times 100, 27.3%. Okay, I'm going to stop there. God willing, 2 weeks time, I will start from Modigliani, the theory of capital structure. So apologies, we can't hold this revision thing on the 20th. Again, because myself and Mr. Adebanjo, we have a retreat to attend. And that was arranged and agreed far before this came up. So apology for that. So we'll see you on I'll see you on the 27th, God willing.
So I have a question.
Thank you, sir. Sir, but we have a question.
Oh yeah, question.
Okay, sir, please, for this one we just finished now, the operating gearing. If you're giving a question, can you use any of the formulas to get your answer?
Yes, so that's a fantastic question.
You can use any of the formula unless the examiner specifies. There are some questions the examiner will insist, say, use this formula.
Okay.
And that's always the reason why you need to know the two. If they have more than one formula, you need to know, because you can say, this is the formula I want you to use. You must follow instruction. If you don't,
yes, I also wanted to ask a similar question when you were treating cost of equity then, when you gave us 3 methods of calculating the cost of equity, like the dividend used method, the Gordon dividend. Can we make a choice of what methods to use, sir?
No, the method, you see, in Yoruba one, the way birds fly is the way you will throw the stone to kill the bird. So in other words, the data that the examiner give you will determine which of the formula we apply. Okay. I'm trying to roll back now to cost of equity. Okay, let's say the examiner just give you this question. Look at this question now. The beta of the company was found to be 1.1. Risk-free rate of return was 9. Return on the Nigerian stock exchange 15. Calculate the cost of equity. You can't come here and be saying KE equals to whatever now.
Okay.
Because where is the dividend? Where is the share price? It's not there. So those formula of K equals to D over P times 1 or Q they are not applicable. John, do you get my point?
Yes, sir. Yes, sir.
So it is the formula that determines, it is the data in the question that determines the formula that we apply. And that's why I always say this course is different from the others, because you have to really be on top of this formula and know the game. Okay.
Someone is a request. I don't know whether it's possible. So if we can get a record of this lecture at the end of every lecture, that will help us or guide us in our reading.
You know, I'm a lecturer now. You have to make that request to the institute.
Good afternoon, sir.
Yinka.
Yinka,
yes. Yinka.
Good afternoon, sir. So I want to address that question. We're putting measures in place to do that, sir.
Sorry?
We are putting measures in place to do that. So they'll get it, sir.
All right. So your answer is answered.
Okay, for the 1 hour in the morning.
So maybe you make your contact available so we can reach you when the arrangement is concluded.
Are you on any of the platforms?
No, sir. I'm even calling from Oka.
From?
Oka, Anambra State.
Oka, okay. Okay. And
Okay,
Yinka,
no
that is the Yinka from the Secretariat. If you just say Yinka from the Lagos Secretariat, the head office now.
Okay. Okay, Yinka.
Yinka from the head office. So you can contact him, we will make it available to you.
All right, sir. Thank you, sir.
Okay. All right. So God willing, see you in 2 weeks' time.
Thank you, sir.
Thank you. Thank you.
Thank you, sir.
Okay.
Thank you, sir.
Thank you.
Thank you.